Let's talk about the good, the bad, and the ugly side of the 2025-2026 finance bill. I have checked it out, and I can say two things before we discuss that further. Is that one, it's mainly going to target businesses, mainly businesses, unlike the previous one where we had certain taxes that were going to affect us directly as individuals. That is one. Number two is that it's more of like cleaning up the taxes that are already there. So they're not introducing any new taxes per se, but how they are increasing their tax base is by amending the already existing taxes, the already existing provisions. Allow me to say that, but I'll simplify this. So that is that. No new taxes, unlike the previous one. And two, it's mainly focusing on businesses. So eventually we will be affected, but it's on an indirect level. We're going to start with the income tax. There is an amendment there. Don't worry about it. I'll summarize it for you. I saw a benefit, and one of the benefits was in terms of people who are employed. There is an increase, that is the tax exempt per diem from 2,000 shillings to 10,000 shillings. Let me explain. Assuming that you're a salesperson and you're given an allowance of 2,000 shillings per day to run your errands, to do the sales calls and everything. That 2,000 shillings that you earn as an allowance per day is not taxed. So if you earn, let's say, if you're given rather 4,000 shillings per day, 2,000 shillings is taxed. Under the proposed finance bill rather, it's going to be increased from 2,000 shillings to 10,000 shillings. So if you receive 10,000 shillings as an allowance per day, it's not going to be added to your taxable income, the income that is used to calculate tax. So it's a benefit to you, especially if you receive an allowance per day, because it's been increased from 2,000 shillings to 10,000 shillings. You get to enjoy that. The other benefit that I saw in terms of tax is gratuity and pension. You see, when you retire, there are two payments that you get depending on the organization that you're retiring from. But assuming that you are a teacher, for example, you're employed by the government, there is that income that you receive on a monthly basis in as much as you don't teach anymore. That is pension. You're entitled to that until you die. Then there's another one known as gratuity. It's a lump sum that is given to you. Gratuity comes from gratitude. So it's a way of thanking you. It's a huge lump sum payment that you receive. So currently, if you are above 65 years old, so if you're supposed to be receiving 35,000 Kenyan shillings every single month, without taxation, you actually receive 35,000 Kenyan shillings every single month, all right? You can see that that exemption applies to people who are 65 years and above, but under this provision, as long as you've retired or you have registered in a pension scheme that is 20 years after you registered, you can still access your pension money and it won't be taxed. So that's a benefit. So more money is going to be on the senior citizens. Not really senior citizens, but once you retire. There is also another provision that I saw which will benefit you as an employee or someone who's employed and who has taken mortgage. You see, currently, if let's say you take a loan for a house, for example, Ivy is employed. Ivy took a loan to buy a house, a mortgage plan. Any interest that I pay on that mortgage is usually used to reduce the amount of money that I am taxed. For example, if my salary is 100,000 Kenyan shillings and I took a loan of, let me just say 1 million shillings, stay with me, 1 million shillings to buy a house. I'm just using that for calculation purposes. And every month I pay around 50,000 Kenyan shillings towards repaying that mortgage. If out of the 50,000 Kenyan shillings that I pay every single month, 20,000 is interest, that 20,000 is usually deducted from my salary, which is 100K. So 80,000 Kenyan shillings is going to be used to calculate tax. So in short, in this amendment, it's going to benefit people who take loans because this time they've added a clause that yes, you're going to be getting that mortgage, that relief, but it's going to be extended to people who take a loan to construct a house. So previously, You only qualify for that mortgage relief from your salary if you're going to buy the house or if you're going to improve the conditions of the house. But now there's that provision where if you're going to use that money, so you can go to a bank and take mortgage as long as you justify that the amount of money that you've borrowed is going to be used to construct a house, not buy a house. You also qualify for that relief. Now let's go to businesses in terms of income. If your business is incurring losses, for example, you are a startup, you run a startup. Startups don't make profits in the first 5 years, in the first 6 years. So under the Finance Bill 2025, you can't carry forward your losses past 5 years. Currently, it's indefinite. So if you are a startup and for the first 5 years, you can carry forward the losses that you incur, you can carry them forward to the next year, to the next financial year, to the next year. It's now limited to 5 years. It's not indefinite. That is not a good thing, especially for startups, like I said, and also for businesses that take time to make profits. They struggle to take time to make profits, and they know that they can get the benefit in terms of taxation. I also feel like it's going to be discouraging long-term investing, because if I was to start a business and I know I'm not going to be profitable in year 1, year 2, year 3, and I can always carry forward my losses, the benefit of losses is that they allow you to pay less taxes. The other ugly side of the Finance Bill 2025 is in terms of capital losses. They cannot be carried forward. Let me give you an example. Assuming that you run a real estate business here in Kenya, you sell property, you sell houses, you sell apartments. Let's assume that you sell a unit at a loss this month. There is this 20 million apartment that you're selling at that is worth 20 million, but you sell it for 15 million in May, because we are in May. So you've made a loss of 5 million. Assuming that next month, this same unit, probably you had a different unit that you are selling that is worth 20 million, and you sell it at 30 million, that is the next month, you see you've made a profit of 10 million. So currently, the 5 million loss that you made the previous month is going to be added to the profit that you made next month, so that you can have a figure that is going to be eventually used for taxation. But not in this finance bill. In this finance bill, any loss that you incurred is not going to be added to any gain that you make. Another ugly side to the Finance Bill 2025 is in terms of preferential tax rates. Let me explain. There are certain businesses that are specifically in the motor vehicle assembly line, or you are a real estate developers. So businesses that are there, they don't pay the normal 30% income tax. They don't pay the normal 30% income tax. There are certain industries, there are certain businesses that are charged 15%, the ones that I've mentioned. The motor vehicle assemblers, and also real estate developers. But even for you to qualify for real estate, before you tell me, Ivy, I am in the real estate business, why am I paying 30% tax instead of the 15% that I've talked about? You only qualify that if you build at least 100 residential units per year, and it's approved by the cabinet secretary. So we have such businesses that are in the real estate development that qualify for this. So for them, according to the finance bill, they're not going to be favored anymore. They're going to be paying the normal 30% tax, just like any other business. So if you are in this industry and you've been paying 15% tax, this bill is not good for you. Another benefit to the Finance Bill 2025 with regard to incomes is that there's going to be a reduction in the digital asset tax from 3% to 1.5%. This is mainly for the crypto traders, because under the current legislation, not the Finance Bill 2025, is that if you're going to sell your crypto, for example, you own Bitcoin, you have to pay 3%. You have to pay an additional 3% of the sale. They're not looking at the profits. So if your crypto is worth, let's say, 100,000 Kenyan shillings, you have to pay 3% of the 100,000 Kenyan shillings, which is 3,000 extra as a cost every time you sell crypto. So currently, under the finance bill, rather, they are planning to reduce it from 3% to 1.5%. Overall, I don't think this is even a good bill, even without the reduction, because why would you want to tax me as somebody who invests in crypto, even if I have not made a profit, for example? I can buy crypto if it's worth, let's say, 100,000 Kenyan shillings, and I sell it at a loss at 50,000 Kenyan shillings, and still you're going to tax me based on a sale. Anyway, let's talk about VAT. We've talked about the income because it's still going to affect you even if you're not employed, even if you don't run a business. There are several things that I noticed in the finance bill. One is in terms of certain goods being moved from zero rated to exempt. Zero rated to exempt. Let me explain how that is going to affect you. A zero rated good is an item that has 0.00% tax on it. A tax exempt good does not have any tax to it. So it's just like a dash. It's a nil. It's a not available taxation, something like that. Benefit to that to any business, assuming that you run an animal feed business, assuming that you run a farm, is that an item that is zero rated, that has 0.00% tax, allows you as a business person to claim tax, allows you to get a refund. A tax exempt good, the one that has nil tax, it's tax exempt, does not allow you to get a tax refund. A tax refund happens when, let's say you're filing your taxes, your value added tax. Businesses usually file, not all of them, most of them file VAT. You've heard of VAT, value added tax. Or when you go to the supermarket, you buy a certain item and you see 16% additional tax on it. So some of the goods that have been moved from zero rated to tax exempt are inputs on raw materials in the pharmaceutical industry. What does that mean? If you're in the pharmaceutical industry and you are importing or producing an item, and these items have now been moved from zero rated to tax exempt, if you're in such an industry and you're a business owner in an industry, you cannot get a tax refund. You cannot claim that tax that you were charged, that you should not have been charged. This is going to have an impact on how you're going to price your goods, which eventually is going to affect us as consumers. For example, again, assuming that you are in the pharmaceutical industry and you file and you make sales worth, let's say, 10 million, or rather, let me just use this example. You pay a tax of 500,000 Kenyan shillings every single month. You can go and claim, let's say, 100,000 Kenyan shillings from KRA and they will return you 100K. Now, if you are in this industry, that is inputs of raw materials in the pharmaceutical industry, animal feeds, inputs or raw materials. So these industries are also going to be affected. If you transportation of sugarcane is also going to be made tax exempt. Locally assembled mobile phones. So if you're in this business, you better listen. Supply of motorcycles and electric bikes, solar and lithium batteries. So if you're in the solar industry, electric buses. What this means is that if you're a business owner in this industry, animal feeds, transportation of sugarcane, solar and lithium batteries, electric buses, you cannot claim the tax. You cannot get that refund. You cannot get the excess tax that you paid back. So what this means is that the prices of these items are going to go up slightly. It's going to affect us as consumers, as people who buy these products indirectly, where we should expect the prices to go up. Another interesting change that I saw in the finance bill is in terms of defining internet services. It's going to be defined under electronic services. So it's going to be under the same classification as web hosting, as softwares, as digital content, as digital marketplaces. What that means is that if you're a foreign company and you're providing internet services, you are required to register for value-added taxes. Let me just relate this with Starlink. You remember Starlink? Starlink is a foreign company and they were talking about bringing in, providing internet services. I feel like they're targeting them in some way. But now Starlink has to register for value-added taxes. If it's Google and they're going to be providing these services, the internet services, they'll be required to register for value-added tax. So they'll be paying taxes to Kenya. So another interesting change which I feel should be talked about is in terms of certain goods that are tax exempt are going to be subject to 16% value added tax. Remember when I told you that tax exempt items are items that have nil absolutely nil taxes on them. They are not zero rated, they are exempt. So some of these items that are going to be now charged 16%, that used to be charged 0%, include locally assembled vehicles for transportation of tourists. So this is going to affect the tourism industry. Goods imported or purchased locally for consulting houses and affordable housing. So affordable housing is going to, the costs that are used are going to be, it's going to be more expensive. The other one is in terms of equipment used to generate solar and wind energy. The equipment that is used is currently tax exempt. It's currently tax exempt, so you can actually claim the taxes. Right now, these items, the prices of these items are going to go up by 16%. Locally manufactured passenger vehicles. Perhaps you have a PSV, a matatu somewhere, and you bought it here in Kenya. It's usually tax exempt. So this time, it's going to be subject to 16%. So the price is going to go up. If you bought a matatu that is locally assembled or locally manufactured here in Kenya and it costs around 2 million, now add 16% on top of the 2 million. This is what we're talking about. You can see that the government has widened the taxes that they want to collect from value-added tax. The finance bill is also targeting the Tax Procedures Act. Again, this one is mainly focusing on businesses, the way I told you. When you are filing taxes for a business, there are certain procedures that you follow. For example, if you overfile, if you overpay the taxes, the value-added taxes, most companies or companies that pay value-added taxes, they pay that on a monthly basis. So sometimes you might find that you have overpaid the tax and you need a refund. You need a refund. So the tax refunds are going to be increased from 90 days to 120 days. You can see that they've increased the time period by which you can request for a refund. The other one that is under the Tax Procedures Act, because this is the Tax Procedures Act, this one is interesting. It's going to affect our data privacy. Under the Finance Bill 2025, data privacy is not protected for businesses. In fact, institutions like KRA are going to have access to the trade secrets and the customer data of businesses. So why would the Kenya Revenue Authority want to have access to the trade secrets of a company? It doesn't make sense. Why would they want to have access to the personal records? So assuming that your business is around education, let's say that you have a software for education or you have a software for health. So why would KRA want to have access to personal data of your customers? So apparently under the Finance Bill 2025, they're going to have access to that. And I do feel like it's a violation of our privacy. If you're going after money, if you're going after taxes, then the auditing bit is enough. The other important thing that I saw in the Finance Bill is in terms of imports and exports. There's this levy that affects certain goods like iron and steel. Not all the iron and all the steel. There are certain provisions like what type of iron and what type of steel. So what happened is that there's currently a 17.5% tax on a certain type of iron, on a certain type of steel that is imported into the country. And mainly it's used in the construction industry. So this is going to affect the construction business. So currently, 17.5% is levied on any imports on that specific type of steel, on that specific type of iron. So that 17.5 is going to be reduced to 5%. Let me explain. So what happened is that this levy on these products that were being imported, these specific products that I've talked about, iron and steel, that 17.5% was meant to encourage local businesses that can produce the exact same type of that steel that is being imported. So we had this 17.5% tax that was imposed to discourage Kenyans or to discourage importers from importing that specific type of steel. So that's why they introduced a tax of 17.5%. But it seems that they have noticed that that item, or probably they haven't noticed, but anyway, they are reducing that 17.5% to 5% so that it's going to be cheaper for somebody who's going to import that. You can see that it's going to affect the construction and the manufacturing sector, since now it's going to be cheaper, relatively cheaper to import that. But all in all, those are some of the few things that I saw in the Finance Bill 2025. Of course, I haven't talked about everything. I just wanted to give you a general overview of what was there. I'm going to leave a link to a certain document that is going to summarize everything for you in case you're interested in reading. But in general, what I can say is that the Finance Bill 2025-2026 is one, more lenient than the previous one. This one, of course, we've seen that the government is trying to straighten the loopholes that already exist. I haven't even talked about the stamp duty. Like, there are several things that have been, several screws that have been tightened with this finance bill. So I can say, yes, it's better than the one that we had last year. Two is that it's more business focused than individual focused. As you can see, most of the things are going to affect businesses and not us, although we are going to be affected indirectly. One thing that stood out for me in terms of the benefits is the gratuity bit. Like, you get to retire with your money and not pay tax on it. In terms of the ugly side, I don't like the fact that they're going to access your personal data. Like, why should they do that? I would love to know what you think about this finance bill. Do you feel like probably they're hiding something? Because that's what I've been seeing on social media, that people are saying there's something that they're hiding. There's something that they're hiding. It's just something. Thank you for watching. I'd love to know your thoughts on the comments.